In today's uncertain housing market, it's important to find safe and smart ways to invest your money. The United States saw a huge increase in home prices from before 2020, lasting for an amazing 41 months in a row. Many people were worried about the high costs of houses, while investors made a lot of money and regular buyers had a hard time of keeping up. At InvestWise, we empower you with key investment insights to thrive amidst market changes. Join our journey by liking and subscribing to the latest financial updates. Let's talk about this time of amazing growth, with the house prices increasing by a huge 51% from February 2019 to June 2022. This never-before-seen rise in house prices, with some cities like Seattle seeing more than 100% increases, made many people worried about whether the housing market was stable. They began to wonder if the country was going to go through something similar to the well-known dot-com bubble from the early 2000s, which could lead to another big crash in the market. Debates surrounding these pressing questions raged on various platforms, including YouTube, Wall Street, and online forums, where people presented arguments both for and against the existence of a new bubble. Although a multitude of evidence could be discussed and scrutinized, the year-over-year change in the Case-Shiller index emerged as a particularly compelling source of insight. This renowned graph traces the history of the American housing market back to 1987 and captures the year-over-year percentage change in home prices at any given time. For example, between December 1996 and December 1997, real estate prices experienced an approximate 4% increase. When examined through the lens of a year-over-year change, the Case-Shiller index provides a comprehensive and revealing narrative of the housing market's tumultuous journey, shedding light on the factors that contributed to the extraordinary price surges in recent years. So why is this graph so crucial? Well, it illustrates how the housing market has evolved over the past 30 years, encompassing 5 distinct yet interrelated phases. One example is the early 1990s real estate market crash. Around this time, a regional crash, or hidden crash as Ravager refers to it, occurred with price drops of up to 25% in various areas, including Los Angeles. Many people aren't aware that the United States experienced a brief recession during this period, which concluded in January 1992. This event marked the peak of the market for the next 13 years. As the economy improved and home prices rose, optimism returned. Investors, speculators, loan officers, real estate agents, and developers all joined the real estate frenzy around the turn of the millennium, driven by sheer greed. The sharp price increases captured nationwide attention, dubbing the phenomenon a bubble. The crash began in September 2005 and didn't end until May 2012. Real estate investment was deemed too risky during the 7-year-long Great Financial Crisis. What factors contributed to the significant recovery in the real estate market from 2012 to April 2022? And what caused the market to experience its first significant drop in May 2022? The significant recovery commenced in 2012 and continued until approximately April 2022. The situation echoed the early 1990s, with home prices increasing as more investors recognized the sector's potential. The real estate market became widely regarded as a surefire path to wealth by speculators, investors, loan officers, agents, and even social media trends. However, the events of March 2020 shifted this trajectory. Both the early 2000s and early 2020s witnessed unprecedented price increases. When annual growth peaked at 20.7%, the market went wild. Real estate investment seemed risk-free and guaranteed to generate profits. Every property from slums to mansions turned into a money-making machine. Property values rose everywhere from Columbus to San Francisco, and this trend was expected to persist until at least May 2022. In that month, the market experienced its first significant drop. As the market declined for 7 consecutive months and annual growth turned negative, experts began speculating whether we had entered a new phase, another crash phase. How could 2 events with such striking similarities lead to different outcomes? This million-dollar question remains unanswered. It appears that we are currently in a transitional phase akin to late 2005, which aligns with the popular belief that the economy operates in cycles. A crash, followed by a slow recovery, then another bout of greed, and back to a crash, has always been the pattern, with leveraging playing a role in speeding up the recurrence of these long cycles from the past. Many people argue that this time is different, with the debate primarily focused on the inventory situation. They contend that there aren't enough houses on the market to cause substantial price drops like those in 2008. According to optimists, there won't be enough for sale signs after the demand shock of 2020 to trigger price decreases. The majority of homeowners who currently enjoy mortgage rates below 3% have no plans to move anytime soon, thanks to improved lending standards. There has been a slow yet steady increase. In a previous video, I demonstrated how, assuming the same growth rate as in 2022, inventory levels would eventually reach what is considered normal for 2019. If you're a subscriber to the channel, you're already aware of this, but there's another factor influencing how experts view these national inventory numbers that hasn't been discussed. While it may appear that there is a shortage of active listings currently, that's not the whole story. What are some potential solutions to the current inventory shortage in the housing market, and how might government policies and interventions play a role in addressing this issue? The housing market has changed as people are now placing greater importance on things like the ability to work from home, having larger living spaces, and enjoying outdoor areas. This shift has created a mismatch between the kinds of properties that are available for sale and the types of homes that buyers actually want. As a result, it might seem like that there's a general shortage of houses, but in reality, there might be plenty of homes that just don't meet the changing needs and preferences of today's buyers. Furthermore, we can't ignore the effects of government policies and actions on the housing market. Factors like low interest rates, financial aid packages, and mortgage assistance programs have played a big role in shaping how people buy homes and how the overall market behaves. If any of these policies were to change, it could potentially cause the market to move in a new direction, impacting both supply of and demand for homes. Another important aspect to think about is the part that new construction and development play in dealing with the shortage of available homes. The construction industry has had its own set of challenges in recent years, such as not having enough workers and increasing costs of materials. However, if more investment is put into this area, it could help improve the situation with housing inventory in the long term. So, while it may seem like there's a shortage of homes right now, it's essential to keep in mind the many different factors that are influencing the market. By considering things like changing buyer preferences, government policies, and the construction industry, we can get a better understanding of what's really happening in the housing market and what might happen in the future. This deeper knowledge can help us make more informed decisions, whether we're buying or selling a home, investing in real estate, or just trying to understand the current state of the market. Let's first examine some background information to better understand the current situation. Looking back at the 2008 financial crisis, we can see that certain regions always suffer more than others during economic downturns. Cities like Phoenix and Las Vegas were hit particularly hard during the last crisis, experiencing steeper declines in value than the national average. These areas often serve as a warning sign for the rest of the country, as they tend to face problems earlier and recover later. If the West Coast follows the same pattern as in 2022, inventories there could surpass pre-pandemic levels by the end of the summer, earlier than expected. If my divergence theory is correct and the East Coast follows suit, an excess supply could lead to a rapid decline in prices. While inventory levels have generally decreased in recent months, this is a typical seasonal occurrence. The real test will come later this spring, in the weeks and months after April, when the inventory levels usually start to rise. Last April, the number of active listings on the West Coast increased by 9%, while it rose by only 1% on the East Coast. If April's numbers are high, we can expect prices to fall in the near future, signaling that the crash has advanced to the next stage. Based on the predictable long-term cycles of housing bubbles and busts over the past 35 years, 2023 could be risky if history repeats itself. Recent data challenges the conventional wisdom that low inventory levels are a problem. As supply numbers in the West have been falling, this summer will be a critical moment in determining the severity of the situation. If you've enjoyed this video, guys, make sure to subscribe to the channel, like the video, and watch this one as well. Thanks for watching.